Good morning, everybody. 大家早上好 OK. 谢谢华总 for having us today. I'm going to be here talking with you on the outlook for Asia and Malaysia in the next half an hour or so. Let's just have a recap of what happened to the markets overall, the markets regionally in the past 4 months of the year. Okay, you can see this table actually summarizes most of the key market indices around the world. Okay, if you look at this column over here, okay, this is the year-to-date performance of most of the regional indices. Okay, and you can see in the first quarter of this year, really, okay, some of the key outperformance include the Philippines market, the Jakarta Stock Exchange, and of course the Thailand Stock Exchange. These exchanges actually return between 10% to about 15% this year. Okay. Now, as you guys are probably aware, in January this year there was a massive sell down across all the equities in around the world. Okay, but equities were actually very fast to rebound in February. I'm going to elaborate a little bit more why those events actually happened. Okay. Now, year to date, really, the ASEAN markets, you can see, okay, on the top, all this, okay, the Philippines, Jakarta, Thailand, even to a certain extent, the Singapore market, were actually the outperformers. But actually, if you look back last year, just a bit of recap last year, 2013, okay, the outperformers were really the developed markets, okay. For example, Japan, star performer, it rose 60% almost, okay, in local currency terms. Of course, the Japanese yen depreciated by about 20-30%, but even in US dollar terms, Japan market was the best performer last year. Okay, followed by the Dow Jones Index US and Europe, the EU stocks index. Last year it rose almost 18%. So this year we can see a bit of reversal. The developed markets actually lag behind the emerging markets that actually rebounded strongly this year. Okay, what about Malaysia? If you look at Malaysia, the KLCI was only up flat 0.1% in the first 3 months of the year. Okay, but it was, if you look back at last year, it was actually the best performer within ASEAN. It rose almost 11%, whereas all the ASEAN countries were mainly flattish or in the negative territory. Okay. This is just a recap of how the markets have done in the past 16 months or so, 18 months or so. As I say, we need to go through a bit of events externally, what actually happened, what are the key events that took place in the last 3 to 6 months. Of course, grabbing headline is the US QE3 tapering. Okay. Now, I think just a bit of background information, QE it's quantitative easing, okay, since the crisis, the global financial crisis that took place in 2008, global economy was actually in a doldrum, okay. Almost all countries around the world were actually, they were all in negative growth. So central banks around the world have to actually come up with a lot of measures, be it a monetary policy, be it fiscal policies to shore up the economy. Okay. Now, US came out with this QE, quantitative easing. Quantitative easing is slightly different from your traditional monetary policy. Your traditional monetary policy is to keep your interest rate low. Okay. But when monetary policy becomes a bit ineffective, they actually came up with a slight variation of that. And this is by injecting money, okay, to the financial systems by buying up all your bonds, your papers. It can be ABS, it can be MBS, asset-backed securities, mortgage-backed securities. The idea is to keep the long end of the yield curve low. Okay, basically to keep your interest rate low. Okay, so and as a result of that, okay, global economy slowly recovered. Okay, slowly recovered. Now we have came to a stage that so much liquidity has been injected to the system. We have come to a stage that we need to scale back, okay, on those programs. So for the first time ever, the Federal Reserve this year actually started to taper its QE program, okay, by $10 billion per month, okay, since this year. So from 85 billion per month worth of bond purchase last year, it has actually been reduced to 45 billion worth of bond purchase every month. Okay. Now, of course, the decision was largely because of the pickup in the economy. I'm going to show you a little bit. Let me just jump to this slide. Okay, over here you can see at the top left chart. Okay, the top left chart actually shows this is actually the GDP growth. Okay, of the U.S. economy. Okay, between 1996 to last year. In fact, we have a bit of forecast over here. You can see, of course, during the global financial crisis, there was a sharp drop in your GDP, negative. Okay, but subsequent to that, economy actually bounced back up. Okay, it actually recovered. Now, last year, I think US grew by about 2% or so. Okay, this year projected to be 2.8 to 3%. Okay, and if you look at this chart over here, you can see unemployment rate. Okay, has actually dropped a long way from as high as almost 10% to 6.3% in April this year. Okay, so all this improvement actually prompted the Federal Reserve, okay, to start the QE tapering. But of course, the key question is, will interest rate be high? You know, interest rate is actually at 0% right now, right, in US, record low. When will interest rate be high? The Federal Reserve, I mean, the new chairman, Janet Yellen, has actually said that the QE tapering will continue, you know, progressively towards the end of the year. And if you assume it reduce, if we assume it is being reduced by 10 billion per month, okay, every month from now on, then the QE tapering program will most likely end by the end of the year. Okay, and the chairman actually say that, okay, the interest rate will most likely be increased 6 months after the end of the program. So that will likely take place earliest in the second half of next year. Of course, previously there were a bit of concerns on the US debt ceiling, but I can assure you, actually debt ceiling, it is something that is not new in US. US is a nation that has been borrowing money to fund their consumption. Okay, it has always been the case. The debt ceiling is always, debt ceiling is, i.e., the ceiling that allows the Treasury to raise the amount of money that they need. Okay, so in February this year, they decided, or they managed to actually suspend it, i.e., to actually raise the limit by a little bit more until next year. So for now, the issue of US debt ceiling and all this is largely being resolved now. Okay, in fact, if you look at the US fiscal position, okay, US has been running a twin deficit. Where I say twin deficit, meaning current account deficit and fiscal account deficit. Fiscal account is actually the US government balance sheet. Okay, you have the revenue, you have the expenditure, but they spend more than they receive, so they're in deficit. Okay, so in fact, actually, US deficit as a percentage of the GDP has actually gone down. Okay, from as high as 10%. Okay, in 2009, it has actually dropped to about 4%. So the issue has, the deficit issue has improved a lot. So that kind of removed the immediate concern from US in the right now. Now, what about the Eurozone? Of course, Eurozone was one of the worst hit region, okay, by the financial crisis, because the government were actually highly in debt. Okay, so there was a lot of sovereign debt issue in the EU. Okay, but if you look at all the charts over here, okay, all the charts over here, you can see in fact, EU. Okay, these are all the GDP numbers. Okay, to indicate expansion or contraction. Okay, EU has been in recession since 2008 for 5 years already. Last year it was still in recession, but in the end of last year, quarterly GDP actually turned positive. Okay, towards the end. So this year, you're going to see EU registering positive growth this year, although it's flat, by probably less than 2%. But EU has finally got out from recession. Okay. But what is more important for EU is to look at the financial stability of the system. Okay, this is the 10-year government bond yield. Okay, this actually indicates bond yield. The higher the bond yield, the higher the credit cost. That means it is very expensive to borrow money to fund your expenditure or whatever expenditure. In this case, the government side expenditure. Okay, now you can see. This is bond yield for the Italy and Spain. Two major members of the EU. Okay. So you can see the bond yield has actually come down. Okay, it has come down from as high as 8%. It's almost half, more than half in fact. So the financial markets have actually stabilized by and large. Okay, and that's very important for growth to continue. But for EU, is it all rosy? I don't think so, because the EU financial crisis, the debt crisis was actually quite a big problem. Okay, so crisis of this sort probably needs a few years to clear it off itself. To fully get resolved. I can point you to some of the evidence over here. You can see the unemployment rate in EU record high. Okay, record high. If you think US is high, EU is triple of that. Okay, if you look at Spain, Italy, Greece, across Portugal and Ireland, okay, some of the unemployment rate is actually running as for Spain, okay, and even Greece and Italy, they're running as high as more than 20%, okay, and it's actually taking a long time to work its way through on the downtrend, okay. Now, and the banking system, this is the loan growth, i.e. the amount of loan the banks are actually lending to the system, to everybody. Okay, loans are actually not, banks are not lending. Banks are not lending. So it's actually, this is what we call a liquidity trap. Okay, although interest rate is low, okay, monetary policy has been supportive, but banks are really not lending so fast. Okay, so as I say, it will take a while to actually fully resolve this problem. But the good sign is that it has actually managed to get back on its feet. GDP has turned positive this year. Now, China. I think China is a very interesting topic. You and I, we are all Chinese here. I think that we have this special inclination to want to know more about what's happening in China. China I think it's a wild card. It will continue to be a wild card. And why do I say that? You see, China is one country in the world that has enjoyed double-digit growth in the past 10 years. Okay? One of the strongest growth countries in the world. Okay, and because it's grown so fast, so strongly in the past, there have been a lot of imbalances that have been built up in the system. Stuff like over-investments, okay? Stuff like over-leveraging. I mean, people borrow a lot of money. Not only people borrow money, the government borrow money, the local governments borrow a lot of money, and there is sign of overheating. Property prices are actually skyrocketing. And there's a lot of over-investment in all the unproductive side of the economy. So that's why the government is fully aware of that. Okay, and the government knows that this thing cannot continue forever. So that's why China in the next 10 years, from the next decade, it has to slow down. Okay, from the you have to wave goodbye to the double-digit growth. No longer, China cannot afford to have those double-digit growth anymore. In fact, the growth rate will have to go down to the more sustainable level. Okay, and because of that, we will see some hiccup in China. From a high growth country to a more sustainable growth country. Okay, and in fact, if you look at the chart over here, this is the what you call the sequential growth, i.e. quarter-on-quarter growth in GDP. Okay, I think going forward, the economists are actually projecting China to grow by about 7 to 7.5%. Of course, the government has a target to grow the economy by 7.5%. Question is, are they going to undershoot those targets? Okay, so this actually highlights again, highlights some of the issues that I mentioned. Okay, oversupply concern in the property side. Okay, this is where the red line actually shows the amount of houses that were being built, and the grey line actually shows those that were being sold. You can see the gap is widening. There is a lot of oversupply in the system. Okay, now excess leverage in this over here. Okay, you can see excess leverage. Okay, we measure this by the total borrowing in the country. Okay, this is private borrowing as a percentage of GDP. The ratio itself is almost 100%. And if you include all those non-traditional banking lending, those lending that is not captured by the banking system, it can be some of the wealth management product. Okay, direct lending by individuals or corporates, these are not captured by the banking system. If you include those borrowing in, this ratio is almost doubled. Okay, it's very, very leveraged. Okay. Okay, so these are some of the issues. So that is why, in a nutshell, the government has to orchestrate a new norm, okay, to actually adopt a more balanced approach of growth for China. Okay, you can see over here they have this 5-year plan. Okay, 5-year plan until next year. The plan is to bring down the growth. Okay, your growth in the past is higher. So now is to bring down the growth to about 7.5% this year. Okay, Japan. Japan is probably a reversal of China. In the last 10 years, Japan has never grew. Japan is always stuck in a deflationary environment. No growth, no inflation. Okay, no growth, no inflation. But last year or 2 years ago, under the new leadership of Shinzo Abe, okay, he has actually come up with QQ. It's very similar to what US is doing. Qualitative and quantitative measures, okay, to keep your interest rate low, to keep your currency weak, and inject liquidity to the system, inject liquidity to the stock market. Okay, some of the measures that have taken place in Japan. Okay, and also they have also been buying back all the papers and all that. That's why the balance sheet has grown. But you see, if you look at the Japanese market, Nikkei has gone up a lot. Okay, of course, this year it has actually slowed down. Okay. Now, but you see, Japan has I think Japan, you need to watch Japan quite closely, because I think the key for Japan going forward is to how to keep the momentum going. In fact, if you look at the latest GDP growth number, it's actually slowed down. Okay, from almost 5% last year, in the first quarter last year, it is actually flat in the last quarter last year. Okay, so to sustain the momentum going forward, for Japan, I think they need reforms, what they call the third arrow. Third arrow, what kind of, these are all the structural reform, like, liberalizing your what do you call, your foreign policies, okay, allowing people to come in, the foreign labor restriction, allowing the women to participate in the workforce. Those are a lot of, Japan really need a lot of structural reforms to actually get the economy to the next level. Now, I think the key question going forward, $1 million question, what's the outlook for this year, for the rest of the year? Okay. Now let's go back to the basic economic stuff. Okay, basic economic stuff. Now, you see, this is a table. This is a table that shows the GDP growth projection for most of the countries in the world, okay, including the developed world and the emerging world. You can see last year was actually was a year of recovery for most, in fact, it has been, the world has been recovering since the financial crisis in 2008. But you can see this year, do you notice one big difference this year? These are all the projections done by IMF, this is done by World Bank, this is done by OECD. These are all the economic projections for GDP growth. Okay, and you have the OECD countries, meaning all the developed countries, the US, the Euro, UK, Japan, Canada, China, India, Asia, Japan, we have Malaysia, okay? And you can see, you'll notice one different, but all the projection by different economists. And you can see 2014, this is a year that you see synchronized growth, positive GDP growth across the world. Okay, US is growing, Europe is growing, Japan is growing, China is growing, and so is the rest of Asia. Okay, so basic economics textbook tell you when the GDP growth is positive, when the macro picture is stable, that is generally good for equities. Okay, that's generally good for equities. But of course, people ask, okay, QE tapering, what about QE tapering? Is that going to derail the whole thing? I think the question is that because US has actually relied on all these measures by the Federal Reserve, by the central bank, by the government. So if you withdraw those measures, can US stand on its own feet? Okay, I think the Federal Reserve think they can. Most people think that they can. Why? As I said, just now, we have seen some improvement in the US economy. I think what I want to show is, you see, okay, over here, this chart over here, housing market in US is a big market, very big. So we need the housing market to recover. Okay, in fact, if you this all the bars over here, the bars are actually showing the housing starts. Okay, the red line is actually the new home sales. Okay, whereas the blue line is the existing home sales. All these are slowly. Okay, although they're very slow, but they are slowly stabilizing and increasing. Okay, and that's a good sign. Okay, and unemployment rate is also improving. So I actually go back to the previous slide. So I think the Federal Reserve, the central bank, is more concerned of mopping it, reducing the liquidity than worried about the growth, the pace of the economic growth. Meaning, because the balance sheet has grown so big, since 2008. The amount of liquidity that the US Federal Reserve had injected the economy is about $3 trillion US. Okay, so they need to, if you continue to let this run, okay, you will go into hyperinflation. There will be over investments, and that a new set of problem may emerge. A few years down the road, so they actually have to scale back. So I think QE tapering, so long it is quite well conveyed. Okay, people is aware of that. I don't think it itself is going to derail the whole process. Okay? Of course, China, are there a lot of risk factors? As I say, it will continue to be the wild card because it potentially will throw up some surprises along the way. China, trust me. So that needs to be reformed, but because reforms are for long-term gain, so short-term there's bound to be some pains, right? And in terms of slowdown, GDP in fact in the first quarter has actually slowed down. First quarter has slowed down to about 7.4%. It's actually below the government target. Okay, I give you one anecdotal evidence. Okay. This two table actually this shows a lot the sell side brokers estimates for the the China's economy for the last 2 years. What I'm trying to say is they are forecasting, for example, for 2012 GDP forecast. They were all forecasting 8, almost close to 9% kind of growth for China, and what the actual number actually came out to be 7.7. And the same goes for last year. So people tend to overestimate the growth rate coming up from China. But the fact is the government has a lot of bullet to slow the economy down. So in fact, China is not free of problem, as I say. The key area to watch is whether there will be any default in all those trust-related products. In China, people will come to you and offer you, I give you this wealth management product, guarantee you return of 15%, and then they use the money to invest in all this like coal company, steel company, and in fact there was a default, the coal company went bust, and the government has to step in to actually pay back the principal to the investors. Okay, this is one of those issues. Okay, let's come back to Malaysia. What's the outlook for Malaysia? I think I just give you a summary first, and I'm going to elaborate a bit more on the individual areas. Okay, I think Malaysia, the growth will continue to be quite robust this year. Last year we grew by about 4.7%. This year, Bank Negara has a range for our growth, 4.5 to 5.5. But in a nutshell, it's a steady, stable momentum for for Malaysia. Okay, domestic demand will probably slow down a little bit because cost is actually rising. You and I think this is quite close to us. I think we all notice that prices are going up, inflation is turning up. So domestic demand tend to slow down. But the good thing is this year we'll see export recovery. Export has been actually declining in the last couple of years. In fact, last year was just flat. This year, I think export growth is one that's going to save the economy. Okay. Of course, private investment side is also growing. Investment driven by a lot of government program. The ETP program is actually one key to drive the investment up. Inflation, as I say, inflation last year was pretty benign. But this year, the inflation, we are projecting it to grow to probably about 3 to 3.5%. In fact, this year, you're going to see inflation turning up, from even higher in the second half than in the first half because of all the subsidy rationalization that took place since September last year. Okay. So going forward, I'm going to share with you whether that, what's the interest rate outlook. As I say, export is going to be the savior of the day this year. You can see this is exports, okay? This is exports year-on-year growth. You can see in the past, export has never really been growing since the financial crisis. Actually, it was very volatile, but in the year-on-year basis, it was negative. Okay, export turned positive last year. Okay, and it will continue to be positive this year, driven by two factors. First of all, external side, US, Europe, Japan, they're all recovering, so the external demand is stronger. And ringgit has actually depreciated a lot, so it actually helps the export competitiveness. Okay, this one I think it has been highlighted in the past couple of months in newspaper and all that. And Bank Negara is actually quite concerned. Rising household debt. Okay, you and I, people on the street, we borrow more and more. Okay, from the banks. Okay, and if you look at the household debt as a percentage of GDP, okay, this number is trending towards almost 90%. This is private house, as in people like you and I, excluding government, we borrow a lot of money from the banks. But of course, if you look at, you ask me the breakdown of the loan, almost 50% of it, okay, is actually in housing loan. Okay, so housing loan, and then another 18% for cars. So you can say that most of the borrowings are actually asset-backed. Okay. But again, it is still an issue. Okay, it is rising, and in fact, it is at all-time high. Our borrowing, our leverage ratio. Okay, as a result of that, the government is worried. The government has come up with a few measures, including the cooling measures for the property sector. I think we all are quite familiar with the cooling measure because they all affect us. Okay, of course, like implementation of RBGT. Reducing the maximum loan tenure for personal and housing loan. I think personal loan is like 10 years. Housing loan is 35 years. Previously was 45 years max. Okay, these are some of the measures to cool down the property side. Okay, again, this is fairly quickly. Let's, I think previously, last year, in fact, I think there was some concern on the sovereign rating. Okay, sovereign rating, i.e., the rating that the country has, it actually indicates how strong we are, how strong our balance sheet is. I think S&P actually downgraded our outlook, okay, last year, sovereign outlook. So that caused the ringgit to plunge last year, okay. But I think this year, ringgit has slowly recovered due to two fronts, actually. Firstly, the fiscal side of the equation, okay. If you look at the government balance sheet has actually improving. Okay, the government has an aim to bring the deficit down. That's why we are going to see GST next year. Okay, GST is to help the government to generate more revenue. Okay, to help their deficit. In fact, they have a target to bring the deficit to 3.5% this year. Last year was about 4.5. Okay. And the current account side is also turning around, okay? Current account, because exports are actually recovering. Malaysia has always enjoyed current account surplus, okay? Meaning we export more than we import, okay? So we are always in surplus. But the surplus has actually come down a lot. We used to have 15% surplus, okay? 15%, i.e. the surplus as a percentage of GDP used to be 15%. But it has gone down to 4% or less than that. So early on there was concern on whether Malaysia will go into current account deficit. So the answer is probably no, okay? Why? As I say, exports are actually recovering, okay? And that will benefit an open economy like Malaysia. And secondly, commodity prices are actually stabilized, okay? So I don't think Malaysia will actually run into current account deficit in the near term. So that kind of diminished the issue about whether there will be downgrade in our sovereign rating. And if there's no downgrades, then ringgit can continue to stay stable or even going stronger. Inflation, you and I know that, is on the rise. I think things that we buy, are getting more expensive. So that is a sign of inflation. Inflation was actually 1.2%, 2 years ago, and that was a 2-year low. But this year it has actually risen to almost 4% in February. Because, we pay more for our fuel, when we pump petrol, and we actually pay more for the electricity since this year. So all this, Bank Negara, in fact, 2 days ago came out to say that, that this, that they are concerned of this financial imbalances in the system because interest rate has been kept too low for too long. Okay, so which means there is a possibility that the central bank may hike interest rate in the July meeting. Let's look at the valuations for the market. I think at the end of the day, let's come back to the stock market side. Okay, now I'm actually all these 3 charts over here show the valuations of the index, the KLCI index. Okay, over here you see the PE. Okay, price to earnings. Basically, this is how the higher the PE, the more expensive the stock. Basically, it's the price that you pay for the company's earnings. For example, if you pay a 10 times price, okay, you take $10 for a company that generates earnings of $1 per annum, okay, versus another company 15 times higher, more expensive. This is how we look at it. A very simple way to look at it. Now, let's focus on PE, okay. Now, Malaysia right now, you can see the red line in the middle. It's actually, that is the average PE that the CI traded in the last, more than 10 years. On average, the CI, the market itself, actually traded about 14 times. Okay, where are we now? We are almost at 16 times. Are we expensive? Yes, we are expensive relative to our own historical chart. Okay. And in terms of dividend yield, okay, even you buy those dividend yielding stock like Public Bank, they give you 5% a yield, okay. The yield itself for the market is also trending down, okay, from a mean of about 3.5%, it has come down to about 3.2%. Okay, why? Because prices have gone up. Yield is actually your dividend over your price. Okay, so when price goes up, your yield drops. Okay, so this tool actually indicates to you how expensive the market is. The market, yes, is getting expensive relative to its historical trend. Then you want to ask me, what about comparison with the rest of the region? Okay, compare with the rest, the peers. Okay, let's look at this chart over here. Okay, Malaysia, this is the PE for Malaysia. Okay, compared to Philippines, Singapore, Indonesia, Thailand, and MSCI Asia, Japan, i.e. Asia as a whole. Malaysia is actually the second most expensive market after Philippines. Okay, the rest, like Singapore, Indonesia, Thailand, and even Asia as a whole, are actually cheaper than Malaysia. Okay, but is it always the case? The answer is yes. Malaysia is always expensive. If you look at this chart over here, this shows the premium, okay, of Malaysia market relative to the MSCI Asia Japan. Okay, on average, okay, Malaysia trades like almost 20% higher. The valuation that Malaysia has is almost 20% higher than the rest of the region. All this while since 10 years ago. So this thing about expensive about our market is always there. Now, is it all so? Does that mean that we don't have to bother about investing in Malaysia? No, that's not the case. I think now I'm going to show you. This is the capital movement, i.e., who have been buying and selling shares in Malaysia since the last couple of years. Okay, you look at, for example, year to date, this year, in the first 4 months of the year, you can see foreign institutions, okay, over here. Foreign institutions, year to date, 2014 year to date, they have been selling 5 billion worth of equities. They have been selling. Who have been buying in the market? The domestic institutions. Who are the domestic institutions? Domestic institutions are the unit trusts, the insurance companies, all the fund managers, okay? The fund managers have been buying, okay, so they have been supporting the market. But if you look at last year, okay, last year, foreign institutions were net buy, okay, domestic institutions were net sell, okay, and net buy also. And the year before, foreigners bought almost 15 billion worth of equities in Malaysia. Now, what caused foreigners to sell since last year? Actually, foreigners started to sell since August last year, and partly because of the QE tapering. QE is a source of cheap funding, and this source of the cheap money has actually flow out from US to the rest of the world, including a country like Malaysia. So Malaysia has enjoyed a lot of foreign money because interest rate has been kept very low across the world. But this year, because of the tapering program, okay, foreigners have actually moved back some of the money away from the emerging market, including Malaysia. That's why we have seen foreigners selling the market. Okay, so as a result of that, the foreign equity holding, i.e., the percentage of equities that were being held by the foreigners in the market, has actually come down from as high as 28% to 23% now. We are quite pretty low. So what does that tell you? Are we done with all the selling? If we are, then the downside is very limited. So it's pretty safe to go in. But of course, nobody can answer that question for sure. Okay. Now, but what is good is to highlight to you, this is a monthly chart. Every month we track the foreigners, what the foreigners are doing, what the local guys are doing. In April, foreigners have actually turned net buyer. Okay, they have been selling the last 6 months, but they have turned net buyer. So that actually says that maybe whoever who wanted to sell are probably done a lot with their selling. Okay, hopefully that is the case. So in a nutshell, I would like to give you a summary of what we think we should do as a fund manager for the market. Okay, our strategy for this year, we are still cautiously optimistic. We're still more optimistic of the market. We think this year will still stand a good chance to give you positive return. Of course, year to date, the market is only flat by only up by 0.1%. Okay, but if you peg the index at 16 times PE, this is what I call the PE, 16 times, a bit technical. Then the index can trade up to 1990. Okay, that's about, the current index is about 1870. Okay, so that's about 6% upside from the current level. But it doesn't mean that if you invest in the market, you can only get that much. You see, the fund managers are here to pick the right stock for you. So the key is to pick the right stock that gives you the extra performance, the performance that is better than the market as a whole. Okay. Now, how do we do that? Okay, some of the sectors that we like. Okay, if you look at point number 2. Okay, the sectors that we like the export recovery plays. Okay, why? As I say, export this year from Malaysia is going to recover. Okay, so you should look at the export recovery plays. Things like Group-tronics, things like Inari, okay, to a certain extent, the rubber glove makers. Okay, we invested in a lot of rubber glove last year, but we have actually reduced our exposure, partly because, first of all, ringgit is probably going to strengthen from now on. Now, ringgit strengthen is good for consumer, ringgit strengthen is not good for exporters, okay? But you see, if demand is strong enough, that will actually take care of the forex impact. Okay, so we like this sector. Oil and gas. I think oil and gas is still the sector that gives you the earnings visibility, because Petronas is actually continue to spend. When they spend, they need to bring out the production level. The oil and gas producers, the oil and gas players, the service providers will benefit. Stocks like Perdana Petroleum, Alam Maritime, Dayang, even UMW Oil and Gas, Coastal Contracts. These are the stocks that we like. Okay, ETP exposure. I think the government is very, very serious about implementing ETP and is going ahead. So you need to find stocks that have exposure in the construction, in the infrastructure spending side. IJN, okay, certain extent the Sarawak guys like the Hock Seng Lee, okay, CMS, even Gamuda, okay, at certain level. Now, just like I mentioned about domestic demand slowing down, okay, so one has to be cautious or selective in your auto side and also consumer side. I still like some selective consumer plays like Caring, your pharmaceutical, Carex, your condom maker, okay, NTPM, papers maker, your NTPM is your tissue paper, okay. Those are the resilient guys, okay, resilient consumer plays, okay. Plantation. Now, plantation is very unique to Malaysia, okay. Only 2 countries in the world that have plantation company listed, okay, and that's Indonesia and Malaysia. Because to the next extent, Indonesian guys also have some of the listed company in Singapore. Okay, now plantation unique to Malaysia, and plantation CPO price last year was totally was a decline. And this year it's rebounded. So this year you're going to see earnings growth for the sector. So we actually like plantation. Stuff like, you have to choose the stocks that give you the growth, okay, and like TSH, even certain extent IOI, Genting Plant, IGM Plant. Property. Okay, say property is, I think property, there's a lot of measures, a lot of cooling measures. So property was totally, underperformed last year. But this year it has rebounded. I think the key is to look for stocks that have already priced in the risk. Okay, IGM Land, Sunway, for example. Yield plays, I think we all know that interest rate is on the rise. So you be selective on your yield play. Don't buy across. Okay, I may still like certain REITs, but I don't think REITs will generally outperform by a lot. Last year it totally underperformed, but this year it rebounded. I would prefer sector like, maybe your telco, DG. Okay, and that's still good. The risk for the market really is when there is worse than expected capital outflow from the market because of QE tapering. Okay, geopolitical crisis is what in Ukraine, this could cause a bit of disruption. These are all the risks. Of course, if we continue to see EPS disappointment, corporate earnings, if you fail to pick up, that will present a risk to the market. Okay. Let me just have a bit of airtime actually to tell you some of our products. Kenanga Investors, we invest both in public money, retail funds like unit trust funds, and institutional money, those like the pension funds, the GLCs, the corporates money. So I'm going to show you some of our flagship unit trust funds. We last year launched our first Asia Pac fund, and this fund was launched in August last year. Okay, and since inception, this is a fund performance. The fund has returned almost 15%. Okay, versus a benchmark of 7%. Now this is this Kenanga Asia Total Return Fund. We call it the CAPTROF. Okay, it's a total return fund with 10% absolute return, i.e. every year we try to give you 10% regardless of down or up market, but it's not guaranteed, it's target return, okay, 10%. So you can see since inception last year, August last year, the fund has totally outperformed the benchmark and the MSCI Asia X Japan, which was only up 6%. Now this year, year to date, the fund was up 5%, the MSCI Asia X Japan was down 1%. In fact, in the 6 months, 3 months, in 1 year period, this one is actually number 1 in the category. Another flagship fund that we have is Kenanga Growth Fund. This is a pure Malaysia fund, okay. Kenanga Growth Fund is an award-winning fund. Last year, It is the best performing fund in Malaysia under the Malaysia category. Okay, since the fund was incepted since 2000, since inception the fund has actually returned 250%. Okay, and that's almost versus the benchmark 96%, totally outperformed. Okay, and year to date, this year, okay, you know that the benchmark is only flat, right? 0.1%. The fund was up 8%. Okay, and it has been consistently given the highest rating by Lipper. Another fund, Kenanga Sharia Growth Fund, is similar to Kenanga Growth Fund, but it's an Islamic product. Again, okay, this fund has also done very well, totally outperformed since inception. And year-to-date basis, the fund is up almost 6% versus the benchmark increase of 1%. So, I think the key message over here is that although the index may seem giving you very limited upside, but the key is really to invest in the right stock. Okay, that will give you the alpha performance. Okay, if you are interested in all this, you can contact one of our representatives after this. Thank you.